Hello everyone, welcome back to our channel Inflate Insight. This is our third episode of navigating the world of inflation accounting. I am Marina Francis. In episode 2, we spoke about the objectives of inflation accounting and delved deeper into the first method used under inflation accounting, which was current purchasing power method. So now here we will be discussing about the second method. The second most prominently used method for inflation accounting is current cost accounting method, CCA. So the current cost accounting technique is adopted in place of the current purchasing power method of replacement cost accounting technique for price level changes. The crux of the CCA technique is preparation of financial statements, that is the balance sheet and profit and loss account, on the current values of individual items and not on the historical or original cost. The current cost accounting system considers price changes that are relevant to a specific firm or the industry rather than considering the whole economy or the general price level. So CCA seeks to arrive at a profit figure that can be distributed safely in the form of a dividend without impairing the firm's operational capability. The CCA method is based on the concept that a business enterprise is an ongoing operation in which the continuous replacement of assets is needed. So the salient features of the CCA method are: fixed assets are shown not at their depreciated original cost but at their net replacement value. Stocks are shown at their net replacement value as well. Depreciation is calculated at the current value of assets. Gains or losses due to the changes in the price level are shown in a separate statement. So this is how CCA works. Inventory consumed is valued at the price at the date of consumption. Under the CCA method, assets and expenses are shown in financial statements at the current cost to replace those specific resources. Thus, profit is measured by comparing revenues with current replacement cost of the assets consumed in the earning process. The CCA method is suitable in what all scenarios? It is suitable when managers within an organization are committed to the industry and also when they are interested in replacing the present plant machinery or any fixed asset with a new one at the end of its useful life. CCA is generally preferred over the current purchasing power technique. This is because it is a complete system of inflation accounting. Financial statements prepared under the CCA method provide more realistic information and make a distinction between profits earned from business operations and gains arising from changes in price levels. As depreciation under CCA is provided on the basis of current cost, the method prevents the overstatement of profits and keeps capital intact. With that, we come to the end of the discussion regarding the techniques used in inflation accounting. Having said that, inflation accounting also comes with certain disadvantages, as I mentioned in the last video. The first disadvantage is the complexity. Implementing inflation accounting can be complex and requires specialized knowledge and expertise. It involves various techniques and assumptions to adjust financial statements, which may lead to complexities in financial reporting as well as analysis. Second disadvantage is subjectivity in assumptions. Inflation accounting relies on subjective assumptions such as selecting appropriate price indices and determining the rate of inflation. These subjective judgments may introduce bias and uncertainty into financial reporting, potentially undermining the reliability of the information presented. The third disadvantage is potential for manipulation. There is a risk of manipulation or abuse in financial accounting, as companies may have incentives to use selective inflation adjustments to portray a more favorable financial position. This can erode the credibility of financial statements and undermine the investor confidence, which is opposed to the actual objective of inflation accounting. There are certain challenges or implementation problems associated with inflation accounting. Let us look at what are those. First one is measurement difficulties. Measuring the effects of inflation accounting is very complex, as it involves estimating the general price level and determining appropriate adjustment factors for various items in the financial statements. Subjectivity, as I already mentioned, the selection of the inflation accounting method or the assumptions made can be very subjective. This can lead to differences in the reported financial information among different companies, so comparability might not be possible. Another critical problem in inflation accounting is training the accountants and others to prepare and interpret the information which has been adjusted for the effects of inflation. Also, corporate profits are watched closely by managers, governments, and investors. Managers may have an interest in maintaining the present level of profit and may resist any kind of adjustment to this profit. For example, to maintain the current rate of taxation that they enjoy. Finally, labor unions also may not agree to adjust financial statements for the effects of inflation, especially if they fear that due to the adjustment, profits or hence the bonuses might decline. As we come to an end of this episode, remember, understanding inflation accounting empowers businesses and investors to make informed decisions in an ever-changing economic landscape. If you found this video helpful, don't forget to like, share and subscribe. Thank you for watching.